Hey, everybody. It's your host, Brian Hunt, and welcome to an episode of Risk On, Risk Off. As you know, if you've seen this show, we cover risk in a lot of different facets. And this, as my background, I have a heavy concentration in construction and risk, and there are certain risks that are specific to the construction and real estate world, as there are would be for pharmaceuticals, manufacturing, natural gas, energy. They have risks that are specific to them, those sectors. But every part of the sector of the economy, and not just our economy, the global economy, is subject to systematic risk, things that sort of permeate in the air and impact everything, whether it be trade wars, demographic shifts, climate change, interest rates. There's a lot of different things that can impact on an organization at the whole holistic level. And a lot of that is sort of baked into the cake with respect to geopolitical risk. And I think we've all learned over the years that things that can happen on the other side of the world can easily spill over to the United States and our economy and our daily life. I think the term that's been used in recent years is polycrisis, where we seem to have a lot of different things happening at the same time. And I think this past year has been indicative of that, with trade wars and increased volatility and conflict in the Middle East. There's a lot of things that can sort of go bump in the middle of the night, and then obviously throw into that the declining dollar. Things are changing rapidly, and also with that, the crackdown on immigration. So there's a lot of things going on that are impacting operations in your business, in your personal life, where really it's helpful to try to get a sense of what that bigger trend is at the macro level. And so I've always been a sort of a buff of listening and following people who could talk about things at the macro level, at geopolitical level. And I had the good fortune to see this individual at our office and talk specifically. And I was just blown away at his ability to look at the bigger picture and drill it down, because there truly are so many things that we don't think about that can impact our future. And so when I saw this gentleman on my in our office, I said I had to have him on my show. So it is with great pleasure and honor to introduce to you Mr. Shailesh Kumar. Mr. Kumar, how are you, sir?
Hey, how are you? Thanks for having me.
Oh, great. I'm looking forward to this conversation. Like I said, I had really enjoyed getting to see you and present in real time. And so I wanted to have the opportunity to come out and talk on my show, because a lot of what you cover, bleeds in specifically to what we try to talk about here. So yeah, obviously, Shailesh, we got a lot to cover, and can't wait to hear you talk. So, but before we get into Shailesh, if we're playing a game of, you're about my age, modified version of where in the world is Carmen Sandiego, where in the world is Mr. Kumar today?
Yeah, I live in Virginia, right outside Washington, D.C., like 20 minutes west of there.
Okay.
So here I am, been here in this area for the last almost 15 years now.
Fantastic. So did you grow up in Washington, D.C., or you were transient to there?
I did. Well, I did grow up in the D.C. area, more on the Maryland side, a couple of different times when I was really young, and then I moved back in high school, and then more recently when I started, I guess, the last 15 years or so, moved right back here again.
Yeah. So obviously I wanted to talk about your background, because I think it's just fascinating and just really impressed you with. So you're growing up in Maryland, D.C. area, and you decided to go to NYU. What made you decide to go to NYU?
Yeah, so when I was trying to go to college, I had a couple different paths I was thinking about. At that time, the one that I was most focused on was med, actually, bio and med, and that's in sciences more specifically. So that's what I thought I was going to do, and then I realized at this juncture in my senior year of high school that I really did not want to do that, and I would much rather go into business. And business was kind of an amorphous term, so finance was the closest proximity I could get from a degree standpoint that made sense for me. In the background, though, I always liked geopolitics, but at that point in time, geopolitics wasn't a word. The word that got thrown around a lot more was either national security or current events or foreign policy. And I wanted to do something around that. I didn't really know what I wanted to do, but finance business seemed to have been more of a linear path forward. So I applied to a few different places. NYU had a very good undergraduate business program called Stern, very similar to the graduate program. So I got in there, applied there, got in there, and that's where I ended up going.
So what part were you? The 80s at NYU? Sort of.
No, a little bit later than that.
That's fine. No, you're probably younger than me. Okay, so what was going? So I'm curious. Like, obviously, the NYU's, it's New York, the center of the universe, especially from finance and Wall Street and UN. What was it like going undergraduate at NYU?
Looking back at it, and I'm always very clear on this point. I always say that when you learn business or any iteration of business, there's what you learn in school. So you learn finance or economics, you learn the theory aspects, the mathematical elements of the degree.
Mm-hmm.
But there's a part that you really can't be taught, which is just you get through osmosis through your environment. by just being around people. And I think that's particularly true when you work. I've always been a believer that most of what you do, you end up learning on the job. You can apply what you've learned in school.
Sure.
But when you're 18 years old and you're in a place like the Village, Greenwich Village, and you're around a city with a lot of liveliness, you end up growing up pretty quickly, metaphorically speaking. And so you pick up a lot of elements that you just can't be taught in the classroom. And given that New York is the center of capitalism, the center of Wall Street and finance and everything else, it also makes it pretty conducive to getting internships throughout the school year and in between the summers, which is what I did. So I was really fixated my freshman year onwards of trying to get a really cool internship. And I did that every year and throughout the school year as well. So you end up learning a lot that happens outside the classroom. And I think that's far more invaluable. And it's hard to quantify what exactly you're picking up, but you're 18, 19 years old, you're in a pretty lively city, you're picking up street smarts because you're just walking around and you're observing things. And then you're also getting these really fascinating internships and experiences, which just adds to what you're learning in the classroom.
Sure. So was it from NYU you straight to Tufts, or did you go work a little bit?
No. So I worked for a couple of years. So when I graduated, and NYU is very big in finance, it's a big finance and business school focused environment. Sure. And I opted to go down the investment banking Wall Street route, but specifically I was on the trading floor. So I did a couple of internships, which led to my full-time job. There used to be a firm called Solomon Brothers, which became Solomon Smith Barney, which then became Citigroup. So I had I had my junior year internship at Solomon Smith Barney on the fixed income trading floor. Based on that, I got hired full-time into Citigroup and became Citigroup eventually. So I was on the trading floor focusing on government bonds, interest rate swaps. I was there. I went to a few different banks, HSBC, and then Morgan Stanley, still doing government bonds, interest rate swaps, and currencies. And so the argument is that throughout that experience, I was transacting, executing, touching upon instruments that are affected by monetary policy, fiscal policy, and geopolitics. And that's what government bonds, interest rate swaps, and currencies are all about at the end of the day. And so, again, going back to the argument I made earlier about what you learn in the classroom, when you're in this environment, you're also picking up on those topics indirectly just by being in that space. So Absolutely. I did that. And then I went to Tufts because going back to my point earlier, I was always really fascinated by geopolitics. Again, it wasn't called geopolitics back then, but by this point in time, it kind of was. So I went to Tufts because I wanted to do something very different. So I went to Tufts to get a degree in international affairs, thinking that maybe I'll pivot my career slightly.
Good. So tell us about your time at Tufts. Obviously, it's a very well-renowned school for international affairs. How did that formulate your future?
Very different experience because all of a sudden you're with individuals who are just thinking about the world in a slightly different way. When you're getting a finance degree, it's a lot of finance, a lot of business, a lot of information about banking and policy and what's happening with financial markets. When you're in the world of international affairs, it's a very different set of conversations, and you're with a very different set of people. All of a sudden, my classmates were in the State Department or Defense Department or think tanks or consulting, and so I'm getting exposed to a vastly different way of thinking suddenly, which I really liked. You're having a very different set of conversations and debates around you. So I found that, again, very interesting to juxtapose against the experience I had had in my undergraduate. And they're both valuable. They're both very fascinating. They're just two different types of experiences you end up getting. So I did that. And then after that, I ended up going to the U.S. Department of Treasury as an economist. So worked there for a couple of years doing a couple different things. My first job there was issuing government debt, which was a nice link back to my previous experiences. So before we were trading government debt, now I'm issuing government debt based upon the fiscal deficit and the budgetary needs of the U.S. government. I then went and helped run a team called the Markets Room, which was a team that watched global markets to figure out if things are going sideways, and if so, what does it mean? And I think the thing I always love to tell people, the coolest part about that job was that we would write a daily briefing for the President of the United States and for the Secretary of Treasury and the National Security Advisor. So we would try to inform them on a daily basis of what's happening in financial markets and what do you need to know about it. And then my last job at the Treasury Department was I was their India economist. So I was overseeing the anything that had to do with U.S.-India economic policy, economic relations. To do that job, I had to be an expert on the Indian economy, the political scene, and to figure out what it is we wanted to do with the government and how we get those points across. So I did that for a couple of years. And then after that, I went to Eurasia Group, which we were chatting about earlier, which is a very famous political risk consulting firm.
What drew you to Eurasia Group?
Going back to my geopolitics fascination, they are very famous for geopolitics, geopolitical analysis, covering the world, writing about what's happening, and making it relevant. And I think that part's really important, which is making sure that anything that you're talking about when it comes to what's happening in the world, making it relevant to the audience. And they're really good at that. So when I left Treasury, it was a very natural flow for me to go. And when I went there, I was focused on South Asian politics and economics. So doing a lot of research more on what's happening in India, Pakistan, Sri Lanka, Bangladesh, writing about it, advising corporate clients and financial institutions about what they need to know about political risk in that part of the world, or even more broadly speaking, Asia generally. I did that for a few years. And then 7 years ago, I ended up making my transition to the world of insurance from there. And so I'm at the Hartford. I've been here for about 7 years now. It's been phenomenally fascinating experience.
Sure.
But what I'm doing now is not what I was doing 7 years ago. So when I came to the Hartford out of Eurasia Group, the need at the time for the firm was we were setting up a credit and political risk department, and they needed to create a research wing for it to help analyze the risks and think about what's happening globally. So I came to do that. That was my first job. So I helped build up the research function for credit and political risk. But then as things happen in your career over time, I just kept evolving and evolving and evolving. And then eventually, a couple of years ago, I pivoted and started what I now do, which is called the Global Insight Center. And the Global Insight Center, the 2-minute catchphrase elevator pitch of it is that we are the internal think tank for the Hartford. We do analysis on the global economy, on geopolitics. We formulate views, and we do this to brief our leadership, to help with internal risk decisions and strategy and analytics and anything else that underwriters and different departments need to know in terms of how they want to move forward. And then the third part of it is working with our external stakeholders. So as you know, in the world of insurance, we work very closely as a carrier with brokers and agents. And so a lot of times I come out and meet with folks on your side, which is exactly how we came in contact, to tell you what I have happening in the world in terms of economics and geopolitics to the extent that it helps you.
Yeah. Shailesh, I got to say, I'm just in a way jealous because I think you and I have a very strong interest in geopolitics, and I kind of got to it sort of circumvent or the path. But it seems like early on, you had a better focus of maybe where this was going, because like you said, when I was in college, it didn't have the word geopolitics, international affairs. And I think what I always found fascinating and what I've enjoyed reading to people like, your former boss, Ian Bremer, or Tom Barnett, who I've had on the show, and Peter Zion, is that ability to sort of take all components, investment, finance, economics, international affairs, and kind of weave it together, because that all those in this modern economy sort of go and interact with each other. Well, I just think it's just fascinating. So I salute you for your ability to get to that point, and I wish I had taken your path.
I appreciate it. It's this I think back to it, and I distinctly remember these moments when I was in high school where I knew I wanted to do something in this world, but at that time, at least, there was no obvious way to execute on it, unless you went into a think tank or the U.S. government or anywhere else. I mean, those are obvious paths, and I could have done those, and you could have done those, but this whole world has suddenly opened up and evolved, and I think it's in part because there is greater awareness of the importance of geopolitics in business. I think historically they may have been seen as two separate worlds. Either you do foreign policy for the government or you're a business person. But now there's a lot more melding that's happening. So I think that has a lot to do with it. So avenues have suddenly opened up. But the other part of it, and I say this a lot, which is I think to be a good economist, you got to understand geopolitics, and to be a good geopolitical analyst, you got to understand economics. The two are melting into each other. Absolutely. And it's not that they're just two separate concepts. Given how the world works, to have a healthy understanding of how foreign relations may be affecting the economy, and I know we're going to talk about that briefly, is paramount. And understanding how the economy is affecting how nations engage with each other is a corollary to that. So the two go hand in hand.
No, absolutely. And so I applaud. I mean, really, having listened to your presentation, I think you did a hell of a job, and we're going to bring back into this conversation. But no, I think it's guys like you are just always. I mean, you put all together. I just find fascinating. So. And then before we get into it, I want to let everybody know, because obviously we're here on LinkedIn live show with Shailesh Kumar. If you have a question for Mr. Kumar, if you look at the bottom right-hand corner of my screen, you see a picture of me with the oval add a comment. Please type in a comment to bring Mr. Kumar's attention. And if you keep it clean, I'll make sure he gets to see it. So let's sort of take this part. Let's maybe to almost like say, go back to when the Hartford created your unit. I would almost say that's kind of like when people started really the great financial crisis and pandemic. If anything, people were really starting to get, I mean, I say concerned, but also aware that there are risks beyond your immediate neighborhood, that things that can impact, that are going on the other side of the planet, can impact you at home. So maybe kind of, if you kind of maybe Mr. Kumar, just like maybe say what's happened, can be a quick synopsis, how things have evolved over the past, say, 7-10 years from a geopolitical standpoint. That's, in your mind, kind of got us to where we are today.
Sure. Okay. I think COVID has been a very pivotal moment. And in the near term, no one says it this way, but just for simplicity's sake, I would like to think about things as pre-COVID, post-COVID. And we were globally on a trajectory pre-COVID. And then post-COVID, we suddenly pivoted in many ways. And there was a lot of disruptions that happened during that time. And obviously that was only 5 years ago, so not necessarily 7 to 10, but you had the post-crisis 2008 environment and what was happening, where there was a slowdown in the global economy and in the US economy. Things started to pick back up and we were going back to a gradual improvement. And then you had COVID. And so again, post-COVID, pre-COVID. And what you saw during COVID was obviously a massive disruption in the economy. So the economy slowed, contracted sharply globally, and then it bounced right back up again. And then it continued on thereafter. But the other iterations that came out of COVID, I think, was that one, on the fiscal stimulus side, you had a lot of spending that took place in the government. And it was necessary at the time. You were facing a lot of unknowns with the global economy. And so things started to get a little disrupted. And so the response to it from the government's side, globally speaking, was that let's inject a lot of stimulus into the global economy to help shore it up again. And that was largely the playbook that was used in 2008. So we kind of had seen it, and many policymakers had already lived through a version of it in some cases. And the second response was monetary policy. So cut interest rates. The impending recession is going to happen, or they thought. And similar to 2008, cut interest rates, increase spending, and that's the response to it. And that's how you shore up your economic growth. And we can get back to stability based on that. And then what started to happen after that is things actually rebounded much, much faster than they did in 2008. And that part may have caught some people by surprise. One of the things that happened is, the GDP, global economy, GDP did start to bounce back. But the second thing that happened, and this part was really fascinating to me, is that you had a surge in savings. And so COVID was unlike any other crisis during that time period that we'd seen up until that time period, which is people were sitting at home. They weren't able to go anywhere because travel was gone, transportation networks were broken, and you couldn't really go on an airplane and go to vacation in Europe. So people were sitting at home and they were making money in many cases. So savings rates started to rise. And this is, again, a really interesting data point, which is savings rates started to rise. People started collecting more of their paychecks. They weren't spending it. So that's what the savings rate is. And then there's something called excess savings, which is how much more money do you have than you did pre-COVID. And again, this is not universal. Things weren't equal, but on average, people were saving more. And that saving resulted in a massive uptick of consumption demand. And that part, I think, caught a lot of people off guard, which is consumption demand went up. Everyone thought consumption would come down because of COVID and the disruptions. And as consumption was going up, production was falling apart in many parts of the world. So you had a supply shortage issue and a demand uptick issue. And that very, very rarely happens in history. You don't find often that things aren't being made fast enough, but yet the demand is going up. And then the other part of it that happened is, as inflationary pressure started to build, as prices started to rise, which became a big story, obviously, demand continued to rise. Demand was still elevated. And again, that's a historical anomaly in many cases. You don't often find prices going up and people wanting to buy more of it. The two to basic economics go in opposite directions. So massive anomaly that caused a lot of dislocation, which we now refer to as supply chain issues. And that was a big word a couple of years ago, supply chain imbalances. Supply chain imbalances further aggravated the inflationary profile. So inflation kept going up, which then affected politics in the West in many cases, and what people perceive to be the issues that need to be dealt with at the time period, which then has gotten to where we are today. So I think it's a continuous story. And the other data point I often like to point out is how we as economists think about stuff versus how people feel about stuff. And I think this part's really, really important to drive home. When I look at, for example, inflation, the big issue, supply chain related issue, inflation has largely normalized today. It's come back down. It's running at about 2.4%, back close to the Fed's target. Not exactly, but almost there. Obviously, there's some worries about where inflation will go, but in this moment in time, inflation is normalized for the most part. However, most people don't feel that way. Most people think and feel that prices are still really out of control. Things cost more, and it's true, they do. Things cost 35% more than they did a decade ago. And the reason things cost 35% more today than a decade ago is because of that COVID era blip in inflation, which completely upended the trajectory of prices. So people are not wrong when they say that things feel like they cost more. So there's a dichotomy between how I look at it through numbers and how people feel about it, which goes back to my point. I think the big story that we're going to continuously talk about, if not directly but indirectly, is how COVID and the COVID era events affected the economic trajectory globally.
Yeah, I mean, I think there's a lot there you're bringing in. And so there's one part I want to circle back. And I think being with your background, and you and I are close to age, and we have the benefit of history and experience. And let me put it this way. When I bought my house 25 years ago, I had a good credit rating, and I got one note for 6.75% and a second note for 8%. And that was, the house was, $155,000. I had good rate. We saved money, and there was still plenty of economic activity going on. Then you have the great financial crisis, and you've got COVID, and you've got, as a result, quantitative easing, and you were probably maybe part of that at the Fed, obviously pushing down, as far as the government pushing down rates to try to stimulate the economy. And so there's a whole generation behind us that had this concept, 2% rates, that's what it should be. And then rates have come up to about to be roughly where they were, back to the mean. And people are, why rates are so high, but this is not high rates. I would say these are the mean rate or the average rates. It's just that we engage in a very aggressive method to try to push down rates to try to save through COVID and get us out of the great financial crisis. We got out of it, and now the rates are back to being, say market level. But we got a whole generation, or people have a perception that this is just crazy. You want to sort of delve into that a little bit?
Yeah, sure. It's a very apt point. There's a chart we often put up, which is the Fed funds rate over the past 40 to 50 years, give or take, from 1980 onwards. And you can see a very evident structural decline. It goes up, goes down, but it is otherwise a downward sloping curve where you've gone from an era of double-digit interest rates in the 80s to mid to high single digits to mid digits to low single digits. And again, there are these two pivotal moments I talked about, one which is COVID, but the other is 08. Pre-2008, pre-financial crisis, being in a 6+% Fed funds rate environment was not out of norm. It was fairly common in the 90s and early 2000s. And again, recessions happen, you cut interest rates, and that's a typical playbook. But after 2008, we went into a period where we had close to 0% interest rates for about a decade almost, give or take. And then they started to rise, and then COVID happened, and they got cut again. And so there is, to your point, a generation of low interest rates, and it has resulted in a couple of distortions or effects, let's just call it that way, that I think need to be understood. Mm-hmm. One is, to your point about right now, are interest rates truly elevated or not? I won't make a definitive statement, but I think perception has some elements to do with it as well, to your point. But the second is, and this part we talk a lot about, which is when you went into that really low rate interest rate environment, what it did is it enabled individuals to afford credit at a cheaper rate. So you could buy a home for low interest rates. You get a 30-year fixed mortgage for less than 3%, for like 2.625% or whatever. And that's great. So you did that. But then the after effects of that, which we're now starting to see, is what we refer to as a mortgage lock-in effect. If you've got about 15 years of really low interest rates and people have locked in their mortgages, the desire or willingness to sell your home and take on what now feels like a high rate, which again, it isn't compared to 1985, but what may feel like a high interest rate, well, you don't want to do that unless you really have to. And so it starts to affect how people behave and change their spending patterns or investment patterns or purchasing patterns when it comes to housing. And I just think it's a fascinating development, which is affecting a bit of what we're seeing in the housing market today, this mortgage lock-in effect and the unwillingness to wanting to sell your existing home and take on a new mortgage. But yeah, simple point is that rates are lower today than they were 40 years ago. The average interest rate, though, however, over the last 40 years has been 3.5%. So we're kind of coming back to that. So yeah, we are above that, but that takes into account the very high interest rate environment and the very low interest rate environment. So we're kind of coming back to this 40-year run rate, which many people are looking at as likely the terminal Fed funds rate, or where things may end up eventually.
Yeah, and that goes to the point where anyone who took macro, we have low interest rates. That unto itself is told to spur consumption, therefore drives up the prices. And when you have, like, say, go back to the days of Volcker, when you're trying to cut off inflation, you got to raise interest rates. And so it's that push-pull that seems to go over time, but eventually the objective is to, get rates to revert to the average, whether that be 4%, 4.5%. But that's just seems like this whole evolution that's occurred over the past 10, 15 years, as far as rates go down, prices go up, rates have to go up to bring them back down. And I think you and I have the benefit of experience some of this, but it's just that going back to perception, people just don't seem to have never lived it. And that's just, I think, part of what's going on in the overall process.
Yeah, I agree. But the one thing I always say is that, or think about, is that this is inevitable. This is kind of how humans are. This is the part of life, which is the same version of this conversation. Maybe not exactly, was probably playing on the year 1980. It's playing on the year 1970, which is that those who look back may have one perspective. Those who are living through it have a very different perspective.
Okay. So let's circle back on another comment that's definitely impacted by geopolitical issues, and that's supply chains. And so we have the evolution of globalization. The world has become flat. China enters the WTO. There's a big, capital likes to go to the lowest cost point, and especially for, lower skilled jobs. Plenty of things are going off to China and other parts of the world to, manufacture moves, and we get the benefit of cheaper goods, and that helps drive down inflation. But then COVID comes along, and then obviously we're seeing this massive snap in supply chains. And I actually had a columnist from reporter of New York Times cover international affairs who wrote a great book about the supply chain during COVID. You walk through that. And it totally, I think too many people have this concept of, just-in-time inventory, but as a result, when you have just-in-time and there's a disruption and you don't have any mitigation to it, then you're going to find out real quick you have bigger implications throughout your manufacturing process. So with that, and now we've got this push in rising hostility or animosity with China, questions about Taiwan, this whole concept as far as maybe reshoring or friendshoring, getting closer, or if anything, which I think is a good thing, diversification of your supply chain versus concentration in a certain area. Would you want to maybe talk about how geopolitical has sort of impacted supply chains?
Yeah, sure. So I think a lot about the evolution of globalization, and we always break up how the story came to be, which I think the historical components are very important to appreciate to get where we are and where we may go. And so I talk a lot about the post-World War II environment. We in the West had our alliances with Europe and Japan, and we largely did business with one another. And that was part of the philosophy, which is we want to prevent another war from ever happening in Europe again. And so the best way to do it is make sure that these European economies are strong and vibrant, and that they're productive, and there's a lot of investment and growth happening. And so we provided a lot of that initial capital, which was the Marshall Plan, to help stimulate the growth and encourage them to adopt a lot of our philosophies when it came to economics and how to run a government in a country. And obviously they did things differently. And in Europe, I think we all acknowledge on the economic side was slightly to the left of the US, but largely we did business with one another. And same true for Japan, which is there was a recognition, even in a post-World War II environment, that Japan is focusing on manufacturing and exports. And even though that was a relatively new concept in that time period, because before that wasn't really a business model that a lot of countries engaged in, there was support by the American government to encourage Japan to do it, and to encourage others, like in Europe and within our own country, to buy those goods, because we felt that this was the best way to get the Japanese economy going and to make them an economic power. And this, again, would be helping mitigate war. So it was an overt policy to encourage doing business with one another, but we, again, largely did it with allies, we being the Western countries. And then the rest of the world did their own thing. And so we had, I wouldn't call it globalization, but we started to see the nascent uptick in FDI, foreign direct investment, trade flows picking up, production happening overseas, but it was somewhat contained within the developed world. Then you get to the end of the Cold War, and to your point, this is when things start to really accelerate, with China starting to come up on the scene as a really big participant in this concept. And so the World Trade Organization is created. We want to bring China into the world order. The thinking is that just like what happened with Japan and Europe, this is the best way to grow the Chinese economy. And once we do this, then they too will become like the rest of the world. And so a lot of production starts to shift to China. Part of it is policy. Part of it is recognition by the Chinese government that they want to have jobs and create all these opportunities for their people and invest in infrastructure and all the other things you want to do along with it. And part of it is also the business community, to your point earlier, is trying to find lower costs of production because wages in the West are rising. It's becoming more expensive to make some of this stuff. And so product often goes to the lowest cost where you can make it, whichever country can offer you the lowest cost of labor capital, land, et cetera. And so China starts to become a really big powerhouse when it comes to manufacturing and exports. And the stat that always blows me away is that by the year 2016, in the year 1990, almost 0% of any imports are coming from China into the US. It's virtually zero. By the year 2016, that number is close to 25%. So in a span of less than 30 years, it goes from zero to almost a quarter of everything coming into the US is coming from China. And it happens through an evolutionary process. So that to me is what globalization is, or what it becomes, which is offshoring of manufacturing because costs become prohibitive. And so the West starts to focus on higher end products or more expensive products or higher margin products or more skilled products, focusing on intellectual property and technology and services and exporting services rather than goods. And this all seems to be okay. And this is what the world is starting to become like. And there's a lot of obviously commentary during that time period about it. Then you get to COVID. And what becomes really evident during the COVID era related production halts in Asia and the world is this is the flip side to being too dependent on other markets for your goods, which is you lose control of the factors of production. You lose control of the supply chain. You lose control of the ability to buy stuff. And you made the comment about just-in-time inventories. Yeah, that was very much a phenomenon in the 2000s, which is run thin inventories. Supply chains are so robust. Shipping is efficient and fast, so you don't have to worry about it. And all of those philosophies were now suddenly undermined and under question. Do we want to be dependent on the rest of the world for manufacturing? Do we believe in just-in-time inventory? And if so, then how do you remedy this going forward? And so the response to is what you're starting to see now, which again, you allude to, this idea of nearshoring, friendshoring, onshoring, reshoring, whatever word you want to use, building up inventories. And what we've seen happen over the last couple of quarters is inventory levels have started to rise. And this is partly a shift in mentality, I think, post-COVID, where businesses are now starting to run higher inventories. And this is particularly important when we get to the topic of tariffs. And some of this happened in the first quarter of this year, where businesses are starting to boost their inventories to get ahead of tariffs or to mitigate some of these concerns that they think may happen again from their past experiences. And so we are undergoing a shift. My belief on this, though, is that globalization will continue. We're still going to have to engage in trade because that's how the world economy works. We're still going to do that, but some elements of it may start to contort and reorient. We are likely going to see a reorientation of where production is happening. New markets are going to start to rise. Friendshoring is real. Some of it may come back to the US. Some of it may come to countries that are more proximate to the US in geography and in philosophy. That also then has implications for how things will move around the world, which I often talk about. The maritime sector is going to likely see some changes. And again, I'll go deeper on this when we get into tariffs. So my view is globalization will still happen. It's just going to look a whole lot different than what we've seen over the last 30 years.
Okay. So before we go on to the next section, tariffs, again, remind everybody, if you're sitting there watching this, if you have any questions for Mr. Shailesh, please go ahead at the bottom right-hand corner. You see a picture of me. It says add a comment. Please type it in there. And if you keep it clean, I will bring it to Mr. Kumar's attention. So obviously this gives a nice segue into the next component of tariffs. And so obviously, look, we have the current situation where the Trump administration is very much believes that tariffs is the way to go about to bring back jobs back to the United States or increase trade. But can we maybe walk about through just, let's go to the past 20 years, what the philosophy has been on tariffs and say the WTO and free trade with NAFTA. Overall, the trend, and correct me if I'm wrong, over history, especially in the past like 20, 40 years, is to bring tariffs down across the country, across the world, to open up markets and to engage in free trade. But obviously that seems like people have, there's this whole segment of the society that thinks as a result, the United States have been hurt by that. I would argue differently, but I would love to maybe you can talk to me about as far as how we got the past 40 years, how we got to this point and where we're going now.
Yeah. So let's go back to that same analogy I made earlier, or that history component about what happened post World War II, this integration with Europe and Japan. The desire at that time to reduce barriers to trade, and one of which is tariffs or taxation on movement of goods, was a pretty innovative idea, because that's not how the world really behaved or thought in the time leading up to it. There was a protectionist bent to the global economy. There was an element of making sure you can protect your industries and not get overrun with imports or the inflow of goods. And so after 1945, for a lot of the Western countries to suddenly turn around and say, we want to aggressively reduce some of this, we want to make it easier to trade, we want to make it easier to invest in one another, was really a big deal. And some of it had to do with currency policy at the time, which is the European currencies being indexed to the dollar for a time period that changed, obviously, eventually. But it was to ensure a normalcy of currency movement, of currency flow, to minimize volatility of currency, to ensure that countries can be vibrant. And that then facilitates trade. And alongside that, as you said, trade barriers were being reduced via the reduction of tariffs. So I just want to emphasize that was a really fascinating and radical view at the time that it should be appreciated. As time goes on, trade improves, trade picks up, tariffs are reduced, and you keep going, and then the big inflection point is, in my opinion, right at the end of the Cold War, where it starts to go on into a heightened level. So Soviet Union's gone, and this view that, hey, the way we've been doing things clearly works, let's keep going down this path, so let's keep reducing tariffs. And so we go through the 1990s of subsequent tariff reductions. And through the WTO, we encourage other countries to reduce tariffs, because the more you reduce tariffs, the easier it is to trade and the more prosperous your economies can be. And that's the philosophy. So we do that. And that gets us to where we are today. So now to your point about, well, what's changing, I think the sentiment issue that I talk a lot about matters a lot. It's hard to gauge sentiment always, because it's an emotive feeling. And yeah, you can do polling to figure it out. But along the way, people are feeling that maybe the way the economy is structured or what they're getting out of it is not what they thought they would. And that leads to this view that tariffs or the inflow of goods may be the culprit. And again, whether it is or isn't is a separate point for now. I'm just saying that that's the perception in many cases, that we're not making our own stuff, so we need to be responsible for making it. And again, I'm going to reiterate the point third time, which is this is where the COVID era changes matter. That I think what happened during COVID and the feel factor that came out of supply chain disruptions has a huge part of the story as well. And obviously, the first round of tariffs went in before COVID, so let's just point that out. But I think it affected how people think about their ability to access goods and where goods are coming from. And so there's a sentiment behind it. And then that's where this concept of tariffs comes from, or the statement that other countries have high tariffs. Other countries have higher tariffs, but the level of tariffs other countries maintain varies. And sometimes they're actually not that high, and sometimes they are high. Depends on the country you're talking about. Well, we can easily see what those numbers are. So the response to this at this moment in time from a policy measure is tariffs, which is tax the good. The purpose of taxing the good can vary. It can be because you want to protect a domestic industry. It could be because maybe you want to raise revenue. It could be because you want to hinder the flow of that good coming out of that country. And the efficacy of and the validity of those varies. So I won't go into all of that, but that's at least the stated goal of these policies. And that's where we are and why tariffs are suddenly on our horizon.
So I think part of the conversation with tariffs, and I want to pin on this, but there's other factors that sort of bleed into this current situation where we are as far as us versus them, is I want to talk about birth rates and immigration. So overall, and it's been well documented by people like in the industry, and it's out there that a lot of the advanced economies, especially in Europe and the United States as well, is showing declining birth rates. And there's a lot of factors into that, but typically, Peter Zion would say, like back in the day, you had kids, you lived in agricultural society, you had kids because they were free labor. But then when you go to the industrial, you live in a city, you find that kids are expensive. And so, it's important input into college can be expensive. And so it takes a lot more resources. So people have maybe fewer children. And throw in that, birth control, access to, that's a whole lot of factors that come into play. But and overall, the advanced economies, or especially places like Italy, are really seeing in Japan drop off in birth rates. In the United States is, I think, not as bad, but we are definitely seeing a decline in birth rates. And we have a whole generation, baby boomers that are retiring now at almost a daily basis. And so you have that top of the pyramid, a lot of people retiring, leaving the workforce. And there's a whole lot of people, there's some people coming in behind it, but that not filling all these jobs. And so can you talk about declining birth rates in economies as far as how that's impacting the economies? And then if you can, and like Peter Zion says, it takes 30 years to make a 30-year-old worker. how immigration has historically and still is a part of the solution to bring people in who can do those jobs that are being left open.
All right. So the first part of your question about how demographics affect economics or GDP specifically, traditionally, and I'm going to emphasize the word traditionally because I think this may change going forward. Mm-hmm. The traditional metric was that young populations, young societies tend to grow rapidly, all else equal, because you have a lot of workers who are young, who are productive, who are working hard, who are increasing productivity, and increased productivity times increased hands and humans and brains. You multiply that, you get GDP output going up. It's a very simplistic way of thinking about it, but you got 10,000 people working really hard versus 50,000 people working even harder. Well, the 50,000 people working even harder are going to produce even more than the 10,000 people, obviously. So having a young population helps in that regard. The second reason is fiscal policy. So in most countries, the way fiscal policy is structured is you tax workers who are spending and earning and living, and then you take that money and you provide benefits to it, infrastructure, education, et cetera, some of which goes back to them, but some of which goes to those who don't work anymore, retirees, in the form of healthcare, pension, Social Security, depending on what the country is. And so you want a larger tax base than you do the folks who aren't working. And so that's, again, where a bottom-heavy society tends to help. And when you look at the going back to the post-World War II environment, post-World War II environment, baby boomer generation, not just in the US, but also in Europe, this is a phenomenon that's taking place. So suddenly you have a lot more younger people than older people. And that's very conducive from a fiscal policy standpoint and from an economic macro GDP standpoint, because you go through the era of the 60s, but really 70s and 80s with a lot of young workers who are very productive and not as many retirees. And so economies in the West are doing really well. A lot of labor, a lot of productivity, a lot of tax being generated, and less and less being necessarily given to other facets. And so you're able to control the vectors of your economy really nicely when you have that structure. We're now getting, so that answers why why demographics matter so much for GDP performance. We're now getting into a period, though, to your point about there's different reasons why, cultural, educational preference, societal structure, et cetera, that birth rates are declining in the West. And it's very obvious. You can see the numbers black and white. So birth rates are declining. And so what we're starting to see happen in a lot of US and Western European markets is that, and Japan, is that they're aging. That's what we refer to. They're aging societies. So more and more retirees, more and more older people, not enough younger people to fill the void of workers that may be exiting the market, that will be retiring. US is aging, but we've seen this story before because there's other countries that have aged before us or are aging more rapidly. Before I get to some of the more stark numbers, Germany is an example. So Germany started aging before us. And when you look at the profile of the demographic breakdown in Germany versus the US, they became top heavy, visually speaking, when you look at the graph of age distribution before we did. So they're already there. Japan is there. Italy is there. And when you look at Italy's projections about where they're going to be going forward over the next 75 years, they're going to see, at the current rates at least, a significant hollowing out of their labor force, of their human capital, because birth rates are declining, in some cases going negative. And so when you look at their top-heavy society, what happens by the year 2100 is their population gets cut in a very sizable manner. The most stark, by the way, is China. So China is an aging society. Part of it had to do with the one-child policy, and the reproductive rates haven't picked up at the same regard. And so now they're getting to a point where they're going to see an exodus of workers over the next 20 to 30 years, and they're not reproducing nearly at the same rate. And this is the number that really blows me away. Right now, China's population is like 1.3 billion. By the year 2100, it's projected to fall below 800 million. So that's a massive reduction in the availability of humans. So that's what's happening. The one country and region, the regions that are upending this. India is a very bottom-heavy society today. And so they're going to hit peak levels in the year 2045, where they get that kind of middle-heavy structural breakdown where a lot of 30, 40, 50-year-olds, that's going to happen in the year 2045. And then as time goes on, they too will become top-heavy, but not nearly to the same extent as these other countries I mentioned. And then Africa is going to come up right behind them. Africa's got the youngest population in the world, sub-Saharan Africa. So they're going to start to become and look like India over the next, let's call it 50 years. So where India is going to be in 20 years, Africa will be there 30 years behind them. And so you're seeing this kind of really, fascinating may not be the right word, but interesting evolution of birth rates and demographic shifts starting in the West, going to the East, and then coming right back around to Africa in terms of what's happening around the world, which then gets us to immigration. All right. So historically, as this trend started to happen in the West, when we started to see a declining birth rates, the response, I wouldn't say maybe the obvious, the aggressive response or the active response to it was necessarily immigration, but immigration played a huge role in filling the void in many cases of this shortage of labor. Mm-hmm. And I'm not going to go too deep into it, but it's important to make a distinction between documented and undocumented in terms of which sectors they go into, which is very different. But across the board, immigration was filling the void in a lot of these Western economies, particularly English-speaking economies, which tend to attract immigrant labor from around the world a little bit differently. So immigration was flowing in, filling the void. And so now the question mark becomes, if we're already going to be dealing with the situation of declining birth rates and population decline, then what role does immigration have to play in it? This is a very big open-ended question, which I'm not going to be able to answer properly. But if immigration historically has been filling the void, going forward, is it going to continue to fill the void or not? Yeah. And if not, then what happens to labor and productivity and economic growth capabilities in a lot of these countries?
Yeah, and just sort of getting conscious of time here, but on that point, we talk about the aging society, and one of the implications of this is how we're going to deal with this is Social Security and Medicare and Medicaid, in the sense that you have, especially on Social Security, historically when it was created, you had maybe 8 workers for every 1 person on Social Security, and the average lifespan of someone after they retired is like a couple of years. Fast forward to now, where you maybe have 2.5 workers for every 1 in retirement, and people live now to well into their 80s. The numbers don't work anymore. And if you're not going to, and especially if you're not going to replace the retirees or that gap with immigration, or you're going to crack down on immigration, you're definitely putting pressure on the social programs like Social Security, which the trustees have already said is inched up a year. I think the recent I saw was 2035, where the funds start going going negative, and an automatic reduction in benefits of 20% would have to occur unless the government does something different. So it's a classic example where all these sort of factors coming together that impact or can impact and will impact our daily lives. And I just find the whole thing just fascinating. So
yeah.
Awesome. Well, I know we're conscious of time, and I've got one big question I want to ask before we go into our personal questions. So, obviously what we do, you and I are, as far as we think of risk, and you look at it obviously from a geopolitical standpoint, and I look at it at a more macro level with my clients. But one thing that I always talk to my clients and ask them is, we think about their risk and their exposures. What's that one thing that would keep them up at night? And so I'd ask you, Mr. Kumar, if you think about the world as we stand today, what's that 1 or 2 things that you think, oh my gosh, if this happens, this is going to be a problem?
It's a continuation of what we were just talking about, which is the labor or the demographic story. Mm-hmm. The nuance to it, though, is that you're not going to see it overnight. It's not going to be an overnight event. It's more of a long drawn event. And I think the shift in demographics, similar to the conversation we've had interest rates, is going to be one that people may not be expecting, or they won't fully appreciate what that means to them. If you go into a world over the next 20 years where you have fewer and fewer workers, well, how is that going to affect the cost of services? To the point earlier about sentiment and how people react to rising prices, not in the immediate term, but over a longer term. If fewer humans, fewer available labor, how do you react to the price of going to a restaurant? It costs more to you, substantially more to you, hypothetically, or getting work done in your car, your house, whatever it may be. If those prices start to rise in a material way because you just don't have the humans and the talent to do it, then what's the response to it? And I think that's a really important element to think about. We often say with the conversation around tariffs should be thought of as, what does that mean for the price of goods going forward? And when we think about demographics, we say, when you look at demographics, you should think about, what does this mean for the cost of labor and services over time? And those two are very integral to our industry, obviously. Mm-hmm. So that's what I would say about labor. Now, the thing we didn't talk a whole lot about is, well, then what are the potential mitigants to this? And I'll leave the cliffhanger, which is artificial intelligence. That's kind of what it goes back to in many ways, which is that some of the services may increasingly be picked up by machines and bots and computers. And the conversation can be handled in a couple of different ways. One is, some people look at artificial intelligence with worry, and obviously that conversation can be had. But in a world where you are seeing fewer and fewer labor, maybe it can be that offsetting factor. Maybe it can help ameliorate some of the concerns you may have around service costs going forward. Let's see.
Yeah. No, I think it's a valid point because being a CPA by trade and 30 years ago, you might know this, these things called Lotus 1, 2, 3 and Excel came about. And people were saying, oh, it's going to take away all the accounting jobs. You don't need it. Well, no, it made people become more efficient. And so I tell my children, my daughters and anybody else is like, it's not yes, will AI take some jobs? Probably. But what you want to do is be the person that learns AI so you can keep your job or be more efficient. And I think you're right on that. I think there's a benefit potentially to increase efficiency, and therefore maybe we can do more with less. But I think the flip side is people who are in sectors that could be outdated by AI are at risk. No different than when the combustible engine came around and took away the demand for horse-drawn buggies. You got to learn to use that technology for your benefit going forward. Awesome.
Great.
All right, Mr. Kumar. So before we let you go, obviously we talked about some heavy stuff. So let me ask you, so when you're not working and thinking about geopolitical issues, what are you doing?
A couple of different things. I mean, my kind of outlet is either I go running or I paint. Those are I know those guitars behind me. I used to play them. I don't think I'm very good. So they just out of tune. So more often than that, I'll be painting, which is what I prefer to do in my downtime.
Watercolors, or what do you do?
Oh, no, oil.
Okay.
Gotta go.
Very good. Very good. Yeah. And as far as running, I run quite a bit, and I was telling you, it was 2 weeks ago. I was in DC and I ran along the Washington, the mall, which I always enjoy that when I have that opportunity. So it was warm, but not overly humid, so I could get it done. What about travel? Do you like to travel?
I do. I mean, by virtue of my job, I end up traveling almost weekly. So I spend about half the year, I'd say, on a plane or visiting a city. And one of the fascinating things about travel, beyond the appeal of traveling, obviously, is what I absolutely love to do when I'm traveling, go running in the town that you're in. You can get a really good free tour in the process. But the other part of it is picking up on the vibe. And from a political standpoint, I find this really fascinating, which is whenever you end up in a city or town or whatever, and you start talking to people, you can immediately start to get a pulse of what's happening and just how different it is across the country. And particularly in the run up to elections, I love doing it because you get to see why people feel the way they do about a topic. And it's not just random. There is a story behind it. And when you do that, you almost get to do a free version of polling of sentiment, which data picks up on. But again, going back to where we opened up the conversation about what you learn in class versus what you experience through osmosis by walking around New York City, same is true for the country. You walk around America, you walk around Europe, anywhere else, just picking up on the vibe. Can't put numbers around it, but I find it incredibly valuable.
Well, so then we sort of pull on that, because I definitely think, especially there are different sectors of the country that are more vibrant, or it seems like they're up and coming than others, or just like good mojo. So I'm curious, when your travels around the country, what are some of your top 3 location cities that you think have a good vibe right
now? I'll give you one.
Okay.
And I don't think anyone would disagree with this. Is Arizona.
Okay.
The economic boom that I see there is very, very fascinating. And the reason I think it's happening is it started because of geopolitics, which is that there was suddenly an influx of data centers, semiconductor manufacturing. And this is not new. This was happening before. It's been going back 30, but it's really started to accelerate recently. That's beget all of a sudden a migration flow. That's beget a demand for housing and construction and retail and shopping and stores and mall and everything else that comes with what humans want to live and enjoy life with. And every time I go to Arizona, I'm just blown away by, again, the vibe and what you sense and pick up in the air. I think Texas has elements of it too. When I go, different parts of Texas, obviously, I think there's more to come there because a lot of production is moving into that region. One of the reasons well, you asked for 3. I said I'll give you one. I'll give you 3. DC is another one, by the way, but for different reasons.
Yeah.
And I live in the Virginia side, Northern Virginia. Some of it's because of government, but some of it's not. People say that, but there is a massive tech sector here that's booming on its own right. And you can pick it up immediately when you go to different parts of the country. So that's 3 for you right there.
Awesome. Perfect. Shailesh, thank you so much for your time. This is a fascinating conversation. I could have kept on going longer, but we got to at least be cognizant of your time. So thank you so much. And we look forward to seeing you again. All right.
Thanks.
So that was another episode of Risk On, Risk Off. I hope you guys enjoyed that. Again, I think Mr. Kumar's insights are fascinating in what the role of a good geopolitician or geopolitical economist, risk management professional how you want to describe it. The job is to look at all the different factors and try to put them together so you can make an informed decision going forward. And like anything in risk management, that was what we're looking to strive to, is take good information to make an informed decision. So I would highly encourage you to, look for him on his writings and maybe get a chance to see him when he's presenting somewhere in the future. But I do believe in this sort of geopolitical world where, the world is flat and we're all very connected, getting a better understanding and sense of what the risks are out there so you can help make an informed decision for not only your company, but also for you and your family, I think is going to be paramount. So until next time, guys. Bye.